Do you know what's worse than earning almost nothing on your savings? Watching your money shrink every single month while your bank gets richer. For years, I thought I was being smart, keeping my hard-earned money in the safest place possible, the bank. But then I started to really pay attention. I noticed something strange. Why was my balance slowly going down even when I wasn't spending? Why were banks charging me to hold my money while offering me less than 1% in interest? Why did my mom lose money just by exchanging US dollars? That's when I started looking deeper, and what I found honestly made me angry. This is what they don't want you to know. I'm going to show you how banks make billions off of people like us while giving us peanuts in return. And more importantly, I'll show you what we do instead. This works whether you have $50 or $500,000. And just to be clear, I'm not a financial advisor. I'm just someone who got tired of losing. Let's break this down. If you ever had a dormant account drained to zero, you're not alone. Banks have quietly shifted their entire business model. Where they used to make money by investing your deposits, they now profit by charging you fees. Let me give you an example. Monthly maintenance fees and activity fees, wire transfer fees, ATM fees, in and out of network, overdraft fees, insufficient funds fees, you name it. They'll find a way to charge it. In fact, according to the Consumer Financial Protection Bureau, Americans pay billions in overdraft fees alone every year. These aren't just small charges, they add up, and most of them hit working class families the hardest. And here's the kicker, while they nickel and dime you, they're not gonna give you anything back. The average savings account earns less than 1%, and that's being generous. Some big banks are still just paying 0.01% per year. That's $1 per year for every $10,000 saved. But wait, it gets worse. Imagine this, you put $10,000 in a savings account earning 0.1% interest. After a year, you made $10, but inflation that year is 4%. That means your $10,000 can only buy $9,600 worth of goods. You lost $400 in value. Even though your bank balance says $10,010, they don't teach this in school, but it's real. And it's why keeping too much money in the bank is quietly making you poor. Banks know this, that's why they're not doing anything to help you keep up. They'd rather collect fees and keep your money parked where it helps them. So what can you do instead? Here's the mindset shift that changed everything for me. Stop thinking like a customer, start thinking like a bank. Banks don't save money, they invest it. They lend it out, they build real estate, they finance projects, they make money work. And now, so do we. But first is through real estate investment platforms. I started small, just a few $100s. Platforms like Fundrise allow everyday people to invest in real estate projects with as little as $10. No, this is not a sponsored ad. I'm just sharing what worked for us. These platforms pool your money with others to fund apartment complexes, rental homes, and industrial properties. They pay returns anywhere from 5 to 9% a year, sometimes more. Yes, there's risk. That's where I recommend talking to a licensed financial advisor. But for me, it made more sense than losing money in the bank. Another is through private bonds and index funds. If you want something more traditional, there are corporate bonds, and US index funds like the SP 500 have historically returned 7 to 10% annually. Jamaican bonds like South Power have offered 10% in Jamaican dollar returns. I've even invested in bonds that pay me monthly. That's money I can reinvest or use. Another is through high-yield savings for emergency funds. I still keep 3 to 6 months of emergency cash, but not in a low-interest bank account. Instead, I use a high-yield savings account that pays 4 to 5% APY. These accounts are FDIC insured and liquid. It's still in the bank, but now the bank's working for me. Another is through peer-to-peer lending and private credit, which is another alternative we explore through platforms like Lending Club and Prosper, allow you to lend directly to individuals and small businesses. The returns anywhere from 5 to 11%, depending on the borrower's risk profile. Of course, there's default risk. That's why we only put it in what we could afford to risk and spread it across many borrowers. It's one way to make our money work harder. And then there's private credit, where you're essentially providing short-term loans to real estate developers or companies. Some of our investments there return 8 to 12% annually. The best part, these investments aren't reserved for millionaires anymore. Platforms have made them accessible. Another is dividend stocks and REITs. One more thing we've added to our strategy, dividend-paying stocks and real estate investment trusts. These pay out regularly, and we treat them as income-producing tools. We're not betting the farm on any single stock, but companies with a long track record of paying and increasing dividends, those go on our watch list. It's passive income that stacks. My mom lost big on a simple USD trade. She bought US dollars from a bank at 155 pesos and had to sell them at 120 pesos. That's a spread of 25 pesos. Multiply that by hundreds or thousands and you've got major losses. This isn't just unethical, it's common. Banks apply wide bid-ask spreads when dealing with regular people. Meanwhile, institutions get better rates. Why? Because they know you won't question it. You don't know what the real rate is. They're banking on that. Tips: before you exchange, compare rates at cambios. Ask questions, protect yourself. And here's another tip. Some fintech apps now offer better foreign exchange rates with far lower spreads. Platforms like Wise, which was formerly TransferWise, and Revolt are built to give you interbank rates, not initiated retail ones. You might not get access to them from your local bank branch, but online, you've got options. Another big shift for us, ditching debit cards. I only use a debit card for emergencies. Everything else goes on rewards, credit cards. My favorite is the Chase Sapphire because it comes with a bunch of rewards. And those rewards in the long term save us money. And here's the secret. You have to pay it off in full every month, no exceptions. Otherwise, the interest charges cancel out the rewards. Also, I use a digital version of my card for online purchases. It's safer and harder to clone. If you're in the US, consider options like the Citi Double Cash Card, 2% cash back, or the Chase Freedom Unlimited, which offers higher cashback rates for specific categories. Match your card to your spending habits. In the Dominican Republic, this deposit insurance only covers so much per institution. In the US, the FDIC covers $250,000. So if your bank collapses and you have more than that, you could lose the rest. Now, is that common? No, but it happened with Silicon Valley Bank in 2023. It can happen again, especially with smaller or less stable institutions. Diversify your accounts and don't let large accounts sit idle. Also, check your bank's credit rating. If they're rated poorly by Fitch, Moody's, or S&P, that's a red flag. Don't ignore it. If banks were paying well, maybe we'd overlook the bad service, but when you're getting paid 0.01% and waiting in line for 45 minutes, why bother? I personally seen banks treat people differently based on how much money they think you have. When I was broke, I was treated like a liability. Now, I can negotiate. That's not right. Everyone deserves clarity and fairness. And don't even get me started on the sickness of 2020. Most banks still demanded full loan payments even when people lost their jobs. Only a few, like CIBC, First Caribbean, offered moratoriums without discrimination. Customer service isn't just about nice. It's about protecting your time, dignity, and your future. Use banks only as a launchpad. Let money flow in, but don't let it sit. Once you hit a threshold, 1 to 2 months of expenses, move the rest into high yield or investment account. Build an emergency fund in a high yield account. Choose something with 4% or more APY and FDIC insurance. Invest for growth. Start small with platforms like Fundrise or use index funds or buy short-term bonds. Just get your money working. Use credit cards for purchases. Earn 2 to 3% cash back, but never carry a balance. Educate yourself. Watch finance YouTube channels, read books, use tools like ChatGPT to explore ideas, but always vet with a real advisor. Avoid accounts that charge you to exist. No monthly maintenance fees, no dormant account fees. There are better options out there like the Capital One 360 account. Track your net worth. Use free tools like Empower spreadsheets to monitor your progress. Watching your money grow motivates smarter decisions. Set a financial threshold. Decide how much money is enough to keep in cash and invest the rest. Don't let fear freeze your funds. There's one more thing I wish I learned earlier. Money doesn't have to be a solo journey. In fact, some of our biggest wins came when we started talking about finances openly with people we trust. A financial advisor, a local investment group, even online communities. But surrounding yourself with people who are also trying to grow financially changes everything. They'll help you stay accountable, share opportunities, like which platforms are performing well, avoid common traps and scams. Build confidence through shared wins. Too often we feel shame about money. We think we should have it all figured out alone. But the truth, wealth is built faster and smarter in community. I joined a small investment club 2 years ago. We pooled funds, discussed real estate deals, and even co-invested in a few private credit opportunities. That group helped us avoid some bad projects and doubled our gains in others. The best part, the emotional support. You need people who understand your goals and your hustle. If you don't have a group yet, start by inviting one friend to learn with you. Share this video, start a WhatsApp chat, talk about wins and losses, ask questions together. Even if you're brand new to investing, you don't have to do it alone. You're not just trying to make your money work. You're building a life with more options. And that's a goal worth pursuing with others. Another underrated benefit, exposure to new ideas. When you're in a group, someone's always reading a book, listening to a podcast, or attending a webinar that you haven't. Instead of spending years figuring everything out yourself, you can tap into collective knowledge and move faster. You also gain perspective. Maybe someone else in the group has already dealt with a platform you're considering or avoided a risk opportunity you're unsure about. Their experience becomes a part of your learning curve. And here's the truth, you grow when you're challenged. A financial community will stretch your thinking. They'll encourage you to set bolder goals. They'll remind you of your why on days when you feel like giving up. Start small, stay consistent, and remember, the wealthiest people in the world rarely move alone. They move with teams, advisors, and networks, so build yours. I know some of this might sound harsh, but this is what's helped me escape a broken system. Banks used to work for us, now they work off of us. The game changed. It's time we play it differently. I'm not saying take crazy risks, but I am saying don't let your money die in a savings account. Take control, act like a bank. Learn, ask questions, invest with purpose, and if you've been burned by a bank or found a better way, I want to hear from you. Drop a comment below, share a story, please subscribe, and let's help each other win. Thanks for watching.